Welcome to the Invest Islands community. Today, we explore an essential guide for anyone interested in property investment in Indonesia, navigating the diverse landscape of property taxes. From initial purchase to ongoing ownership and eventual sale, this video will be your comprehensive guide to every tax detail, with a focus on Lombok, where Invest Islands simplifies and secures your property investment. In Indonesia, as in many parts of the world, the government imposes taxes on both buyers and sellers during the transaction or transfer of property ownership. When you acquire property directly from developers, you are initially subject to an 11% value-added tax, known locally as Pajak Pertambahan Nilai. When purchasing property through a PMA company, you will also encounter the acquisition duty on rights to land and buildings, known as BPHTB. This transfer tax is set at 5% and is calculated based on the higher of the transaction value or the government-assessed value of the property. Sellers are not exempt from taxation. They are obliged to pay a tax amounting to 2.5% of the transaction value upon the transfer of ownership. Additionally, a notarial fee, typically around 1%, is due at the time of signing the paperwork. For those opting for a leasehold agreement known as hak sewa, the applicable tax rate is 10%. This encompasses any transaction under this type of agreement, ensuring that all parties fulfill their tax obligations as mandated by Indonesian law. Every year, property owners in Indonesia are required to fulfill their financial obligations by paying the land and building tax, known locally as Pajak Bumi dan Bangunan. This annual tax is calculated based on the government's assessed value of the property, taking into account several factors, including the property's location, type, and usage. The rates for PBB can vary significantly across different regions, influenced by local administrative policies and the developmental index of the area. Typically, property owners should expect to pay between 0.1% and 0.3% of the property's assessed value. Generating rental income from your property in Indonesia incurs specific tax obligations. Such income is subject to normal income tax rates, which vary based on the total amount generated. Moreover, foreign property owners are required to comply with withholding tax regulations. This means that taxes on rental payments must be collected directly at the source and then remitted to the Indonesian tax authorities, streamlining the tax collection process and ensuring compliance from all involved parties. For properties managed under a PMA company, the withholding tax rate is set at 10%. Conversely, for foreigners who hold a leasehold or hak sewa agreement, the withholding tax rate is 20%. Understanding these distinctions is crucial for effectively managing your tax liabilities in Indonesia. For a PMA, foreign-owned company in Indonesia, dividends distributed to foreign investors are subject to a 20% withholding tax. But this rate can be reduced if a tax treaty exists between Indonesia and the investor's home country. Some foreign investors may benefit from a lower rate if they meet the treaty requirements. Furthermore, dividends can be reinvested back into Indonesian projects to avoid immediate tax obligations, as reinvested dividends are exempt from withholding tax under specific conditions. Non-residents with leasehold property in Indonesia typically do not receive dividends directly unless they hold shares in a PMA. Their income from such holdings would be considered rental income, which would be taxed under separate regulations. Non-residents who are not tax residents of Indonesia pay 20% tax on dividends, though they could benefit from tax treaties as well. Strategic planning for capital gains tax is essential. Timing your property sale is a key factor that can significantly influence the tax payable. For instance, holding onto your property for a longer duration might not only allow for appreciation in value, but could also benefit from certain tax adjustments, effectively reducing the tax burden when you decide to sell. At Invest Islands, we guide our clients through these considerations, helping you make informed decisions that optimize your financial outcomes and ensure compliance with Indonesian tax laws. To attract more foreign investment, Indonesia offers several tax incentives, especially in designated areas like special economic zones. These incentives may include reduced property tax rates, exemptions from certain transaction taxes, and even full tax holidays under specific conditions. Such incentives are designed to promote economic growth in targeted regions by making investment more attractive and financially viable. Navigating the property tax system in Indonesia, as any around the globe to be fair, can be complex. But with the right information and guidance, you can manage your investment confidently and efficiently. We hope this guide has illuminated the path for your successful real estate endeavors in Indonesia, and we offer to all Invest Islands clients the most comprehensive and complete. For more insights on property investment in Indonesia, please subscribe to our channel and check out our other resources for detailed information and professional guidance.